Hello, welcome to another edition of Nucleus Investment Insights. Today we want to talk a lot about some of these superannuation issues that we have coming up at the moment, which is it's getting very close to the end of the financial year, and there's a whole bunch of different ways you can use superannuation to legally shrink your tax bill. And so I just want to run through some of the big picture issues and a bit of a checklist for people to run through, just make sure that you're actually capturing all the main things that are relevant to you. So just a reminder that everything you hear today is general advice. It's not personal financial advice. If you do want personal financial advice, we can either help hook you up with someone or so register and speak to us. Links are all in the show notes. And with no further ado, I'll sort of get straight into it. So there's sort of what I really wanted to talk about was four different factors about why you would be doing this in a big picture sense. And I'll try to, as much as possible, sort of avoid using concessional, non-concessional, and getting into the sort of jargon of it, to sort of keep high level so you know what you're doing, because there is so much different naming conventions and acronyms and all that type of stuff like this. It all gets very confusing and changes. Like there's been significant amounts of changes to what's going on with all this over the years. So there's sort of four different factors. First of all, reducing your current income tax is a big one. So what we're talking about there is how do we get your current income tax levels down, and there's lots of different ways we can do that. And that's sort of an immediate, but obviously sits it then into superannuation. There's a number of different strategies then you use in terms of getting what I'd call tax-free retirement income. So once you've got your money into super, once you retire, it's effectively tax-free, depending upon certain levels and terms and conditions for a lot of these. So I'm talking broad sense, but largely, if you had a choice between, say, having $1 million sitting outside of super or $1 million sitting inside of super in retirement, anything you earn on that $1 million sitting inside your super is tax-free. Anything you have outside of super, you're going to have to pay tax on whatever you're earning on that. And so, you can be talking tens of thousands of dollars per year, if you have reasonable superannuation balances. So, that tax-free retirement income is important. And then so there's certain strategies about how do I get that money into super, and we'll run through a few of those. Reducing tax on inheritance. This is a little bit of a lesser topic, but there's certainly, if you die before you've used your super, then the people you pass your super on to may have to pay tax on part of it. So anything you haven't already paid tax on, they will have to pay tax, likely have to pay tax on. There's, again, a bunch of whole different rules and regulations around that. But there's also strategies you can do in order to minimize that level. And then finally, you can use your superannuation to sort of save for your first home much more efficiently in terms of trying to get your trying to get first home buyer benefits from that. So moving straight into it is the reducing of income tax. So first of all, there's compulsory super. So this is 11.5% of whatever you earn. At the moment, it's about to go to 12% as of 2 months' time. What do you have to do about this? Look, mostly nothing. It is worth checking that you are getting paid the right amount. Particularly, I think if you work for smaller businesses, it's well worth checking that what's going into your account is the right number. It's probably I should extend that to larger businesses. There's been a lot of larger businesses caught in salary miscalculations as well. So so checking you're getting the right amount is important, and that if that's something that you're interested in and you're a client of Nucleus Wealth, we can certainly help you with that. Getting then additional super into your via your employer. And actually, sorry, I should start with the broad overview on this. Why are we doing this in the first place? Well, you're getting taxed at 15% within your SuperFund, whereas on any money that goes in that, on any pre-tax money, whereas the tax thresholds are typically much higher if you are if you're looking outside of super. So if you had a choice between getting, say, $10,000 paid in your super, you're going to end up with $10,000 pre-tax. You'll end up with $8,500, depending upon a whole bunch of factors, but in a broad sense. Whereas if you had that extra $10,000 paid to you as part of your salary, then you can pay up to 47% tax on that, and for most people, it's probably a tax rate of 30% or 30% plus. So significant savings. You can basically halve your tax bill on the tax for most people, and if you're a higher income earner, you can cut it by a lot further than that. So that's sort of why we're doing it as a big picture. The second part then is how do you actually do this? So a couple of different ways you can do it. The first and easiest way is just making additional super via your employer. So this is called a salary sacrifice into superannuation. You basically just talk to your employer about it. They'll have some sort of form that you can fill in, and then you just up your rate, and you that sort of gets you savings in terms of your super. The other way you can do this is, the other thing you do need to check with this as well is just checking your balance as at the 30 June the prior year. So 500,000 is the key level, because if you're below that level, you can do what's called catch-up contributions. So you can add more into your super, and particularly I think for small businesses, this is often a lot of small businesses, people haven't been paying themselves superannuation. Because it's if you own the business itself, it's not compulsory. Compulsory to pay your employees, but for a lot of business owners, they've sort of not done that. And at some point, as they're starting to get close to retirement, this becomes a much bigger deal. And so, below 500,000, you want to be able to get your start getting your catching up for prior years. So, and then the next part is that checking your marginal tax rate. And so, what I mean by that is, really depending upon what your marginal tax rate is, will determine whether you want to do this. So if you're earning, say, less than 50,000 or less than 45,000, then your marginal tax rate is actually only 16 cents in the dollar, and that basically makes no difference to you're saving a cent below that, or under 20,000, you're actually paying super that you might not have otherwise needed. You're actually paying tax in your super, but you might not have actually needed to pay. So you don't want to sort of go under 20,000 in terms of income. So if you're thinking about trying to pour as much money into super, especially in the last couple of years of working, then you probably you don't want to reduce your income below 20,000, because at 20,000 you're not paying any tax anyway in your own name, whereas in super you are. So, but then you get to certainly once you get to between 45 and 135, you're on a 30% tax rate, plus a Medicare as well takes you to 32. So it's you get about basically 25% return on your money by putting it into super rather than not putting it into super, and that's a pretty decent return, I think, for on day one to get 25%. It's sort of pretty hard to make that up from other ways. So what do you need to do in terms of that? Speak to your employer, get that money sort of shifted in, and check your marginal rate. Once you go over the cap, so you can put up to 30,000 within that. Once you go over that 30,000 cap, there's an additional 15% that gets levied upon you, which is negative. Certainly, if you're earning below 135,000, now it'll suddenly makes the whole thing line ball. You basically save yourself some Medicare levies. But above 35,000 and certainly above 190, there's still pretty good reason to say, oh, well, if you're close to retirement, that is, to say, well, I might have been paying 47% tax. Yeah, I've got to pay an additional 15% in super, so now I've got to pay 30%, but it's still better than paying the 47% tax if you're getting it in your own name. So so that's what we're doing in terms of that. The other way, so we've spoken about via your employer. Let's do it via your employer. The next way you can do it is you can actually make a payment from your savings. So if you're getting close to the end of the year and you've worked out that your employer is going to make, say, $20,000 worth of contributions for you, and you've got another $10,000 you can make, and maybe some catch-up contributions, is you can take that money out of your savings, put that into your super, and then put in your tax return a claim to get your tax back that you paid on that. So the idea is, yeah, you've paid money already, and so you can get that back. You've already paid, say, whatever your tax rate is, 47% tax, say, whereas because you're putting it into super, it should only be at 15%. And so, yeah, get that money back. So how do you do that? Now, that you need to fill in a form with your super fund. If you're a client of Nucleus, you can either send us an email and we can help you out with that. Some of them we just need to inform the super fund. Other ones we actually might need you to fill in a form. But basically, the idea is you can put after tax money of your own in there and then claim that tax back. So it's two ways. Then if you're in a relationship and one of the partners is earning a low salary, then there's a number of different ways as well you can use to reduce your income tax. So there's spouse contributions. Basically, you can contribute on their behalf and you can get an offset. So again, this is after tax money that you're putting in, and they'll give you an offset for tax paid in terms of that. There's a co-contribution as well, where effectively your spouse puts in more money into the super, and the government will match that up to a certain level. This co-contribution for me is a bit of a weird one in that it's sort of almost designed just for people who have partners with low earning partners, because it's one of those things where if you are a low income earner, it's pretty tough to then turn around and say, yeah, I'm not making much money. Let me go find an extra $1,000 that I've got lying around and put that into my super so that the government can match that. Because you're on a low salary, and so it's hard to make that work. So this is one that sort of very much fits for that code contribution. And then the other thing you really should be thinking about as well, not as much about reducing your income tax in this first part, but some of it is about this idea of the contribution splitting. So about saying, well, if I can start evening out some of these, the superannuation balances between the working partner and the non-working partner, is that we've seen some caps starting to come in that the government's starting to do, and so on and additional tax rates that they look like they're going to be charging on superannuation balances, and so the earlier you can get sort of evening them out, the better. And so what I'm talking about there is that there's a $3 million limit, and the Greens are working hard on getting that to a $2 million limit. But what that means is, let's say you've had one partner working their entire life, and they've got $2.5 million in super by the end of it. And keeping in mind that with inflation and stuff like that balance may not be as big as it might seem to some. And the other partner's got a few $100,000 left. Is you might find that the partner with a lot of money in their super is now getting all this extra tax, and the other one isn't. Whereas if you evened it out and both partners, say, had 1.5 million in super or 1.4 million or whatever, that you neither would have to pay those additional tax rates. So there are some strategies to get around that, but basically the sooner you get on that, the better it is, and the easier it'll be, because the strategies you've got are very incremental in terms of how you can start switching between those. So yes, so anyway, so that's the first part, which is reducing your income tax. Next, I want to talk about how you can get more money into super over time, and what the sort of strategies you work out there, and how that means sort of ends up in terms of a tax-free, just after this message.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Right. So the next part then is this idea of tax-free retirement income. Now it's pretty simple. Yeah, I spoke about that, the $1 million before. You got $1 million in super, in pension mode. Now that's tax-free. Any earnings you have on that, you pay zero tax on that. Vice versa, that same amount of money sits in your own name, then you're paying tax on whatever that earns. So yeah, the idea is you want to try and get that into that. And so what we do as well for some clients is we try and manage across their personal super and their outside of super investments. So what we try, I'm a big advocate of, you should be looking at your entire asset allocation and not sort of worry. You don't sort of look at your super and go, oh, okay, I need to have this much international, this much Aussie stocks, this much bonds, or whatever it is within that, and then I look at my own money elsewhere, sitting outside of super and try and run something. You should be looking at that whole as a whole. And the reason why you do that is because you can take advantage of franking credits. But often what you can do is take advantage of franking credits in your own name better. And you can take advantage of capital gains and income payments from bonds better in superannuation. You'll typically have a lower tax rate on that. So it's an idea about saying, well, if I can split my assets, and I'm still might end up with the same asset allocation. I might have 30% Aussie and 40% international, and the remainder in cash and bonds. But I'm splitting up so that most of the Aussie is sort of held within outside of super, where you're getting the benefits of, and most of the Aussie where it's paying franked dividends is held outside of super, and then the money sort of not paying franked dividends or where you're expecting to get more of that capital growth is inside super, where it's going to be more tax advantageous. Yeah, so if you need some help with that, and if you're a Nucleus client, drop us a line. We can certainly help with that. But yeah, so the idea is we want to get as much money as you can into this tax-free environment. So there's two things sort of keep in mind. There's what they call a transfer balance cap, and that is currently 1.9 million and about to go to 2 million. And this is about how much money you can get into your pension and still keep it at that tax-free sort of level. So if you're not at that cap, or and say you've got a pension and an accumulation, or you've got money sort of sitting outside of super, you want to be trying to look at getting money into that sort of pension phase where you can take advantage of that that tax-free status. So that's one part. Then there's this idea of this total superannuation cap. Now, typically this gets done at 30 June and it's all at market rates and everything like that, and that sort of carries forward for the next year. So that sort of puts different restrictions upon what you can do. So if you're below 500,000, you can do these catch-up contributions and get more money in and whatever. The next level is this sort of 1.7 million, or I think it might be 1.68 or something like that, where it restricts bringing forward some of these other contributions you might want to make. At 1.9 million, you can no longer make, and about to go to 2 million, you can no longer make non-concessional contributions as well, which is sort of the money you've paid sort of after tax into there. And then finally you get to the stage where probably 3 million, could be 2 million if the Greens, that's what they're lobbying for. So Labor wants to was trying to get it through last time. So it's an additional tax rate on superannuation balances over 3 million. They couldn't get it through. They don't have the votes to get it through the Senate without help at the moment. There's no way Liberals are going to help them out on this. So they're probably going to need almost certainly going to need the Greens, and the Greens are pushing pretty hard to get that down to $2 million. So anyway, and that's where this extra tax is. But the idea is, how do you get more money into your super? So you've got all the above ones that we spoke about. So so it's using compulsory super, adding extra super via your employer, making a payment from your own savings, and then using some of these your partner ones to sort of even out those balances. So that's one way. All those are great in terms of getting money in, and particularly when you get close to retirement, it's well worth thinking about saying, whatever it is, you might need. There might be $20,000 that you genuinely need to live on out of your, that you're getting paid, but you might have some savings that you can sort of run down, and then get your employer to pay that money straight into your super, as an example, so that you're sort of running down your savings in order to get more money into your super. So you've got those methods. The other one you can do is you can transfer money from your savings into your super, but there's certain limits around this. You got like a 3-year catch up. There's limits about how much super you have. So if you've already got $5 million sitting in your super, you can't do this. But there's about 120,000 a year at the moment, and that you can do in terms of getting that money out of your personal name and into your super, where they're then going to be tax free going forward. And then the second part is this, with that is then also that idea about balancing between your partners. And so if you do have spare money sort of sitting or savings sitting outside of super that you want to get into your super, then you want to be trying to get it into the lower earning partner. There is also a downsizer. So if you're downsizing and post 55 at the moment, you can then put extra money in if you sell a house. So particularly, if you're sitting on a bigger house and you've got kids and you've sold that house, and then you want to and you're going to buy a house which is cheaper, then you've got a one-off chance to put some extra money up to 300,000 into your super and get that benefit of that sort of tax-free money. And so and it's significant amounts. So this can be tens of thousands of dollars per year that you're going to be saving if you can get that money into pensions rather than having it sit outside of super. Right, so that's your tax-free, getting money into that tax-free. I'll talk a little bit about the inheritance side as well. So basically what this is that if you've got adult inheritors and you die before your superannuation is you've used up all your superannuation, is that there's up to 17% tax payable by those inheritors. So $100,000, that's 17 grand worth of tax that your descendants are going to get could get taxed on that money. Now, some of these strategies I spoke about before about moving. Let me start again. In a big picture sense, what this is really about is if you've received money and never paid tax on it. So your employer moved, or you've only ever paid 15% tax on it. Your employer moved, $30,000 into your a pre-tax salary into your SuperFund, and then you got taxed 15% on that. What the government's effectively saying is that's only ever paid a notional amount of tax. You should have been taxed a lot more of that. So we'll let you have that tax-free while you're yourself. But if you then die before you've used that, you pass that on to your descendants. If they're adults, then they will need to pay an additional up to 17% on that, is effectively what they're saying. But if you've talked about some of the strategies we used earlier, where you've taken money where, say, $100,000 from selling your house and you've already paid tax on that, and you're moving that into super, or you've taken $100,000 of your savings that you've effectively already paid tax on and moving that into that's not going to be taxable to your inheritors. So you don't have to worry about creating an extra tax liability for the people who might inherit this money, but for money you're moving in that you've already paid tax on. But you do have to worry about it for the money that's sort of sitting there that you've received from your employer and has never been sort of taxed at the full rate. So the rules are complicated, but the simple version is if you haven't already paid tax above the sort of 15% super tax, it's probably taxable if you're going to die. So how do you get around this? It's what's called a recontribution strategy, and effectively, if you pulled $120,000 out of your super when you're in pension phase, it's not taxable. So you can get that $120,000, grab that, turn around and stick it straight back into your super. Called a recontribution strategy, and there's age limits, there's limits to how much you can do every year. There's limits to how big your balance is when you do this, but it is a strategy that is definitely available. And if you've got $800,000 or $1 million in super, and you've just retired and you're 67 or something like that, then you do this every year for a few years, and pretty quickly you've got it to the stage where whatever's left when you pass away is tax free to people who are inheriting that. So yes, so that's where you should be thinking about how to reduce that on inheritance. I've got a number of questions starting to tick up, and certainly welcome to anyone to add in more questions if you've got some. I will jump to those in a minute. I just want to move to the last one, which is saving for your first home more efficiently. So this is probably at completely the other end for a lot of people listening to this. But it's well worth thinking if you've got kids or nieces and nephews and things like that. This is about the first home buyer super scheme. And the idea here is it's not about using your super for your home. This is not like the Coalition's suggestion that they're about using the super. This is about using the tax rate in your super fund in order to save more efficiently. So the thing to keep in mind as well is you can't use your compulsory contributions, the things your employers put in, or the things your employers put in because they have to. It has to be additional contributions that you've got over and above that compulsory rate of 11.5 at the moment and 12 next year. But let's just use an example of this to say you've got somebody on $100,000. They've got a 32% tax rate. They want to save $1,000 a month pre-tax. So outside of super, they start with $1,000. They end up with $680 because they pay the 32% tax. Inside of super, so instead they tell their employer they want to salary sacrifice $1,000 per month for pre-tax. Now they've got $850. That's a 25% return on day one. It's pretty hard to beat that. The downside, you can't get it back. So and there are there's limits and all this stuff around this and about what happens. But once that money's in there, it's there for a house. Let's say you've put away $15,000, $20,000, and you decide you no longer want to buy a house. Now you'd love a around the world trip or a new car. You can't do that. So there's some things about hardship you could use to try and get money out of super, and that's true of all super. But I'm pretty sure it's the extra contributions you're making if it's a hardship isn't a around the world trip or a new car or whatever it is that that you wanted to sort of spend that money on if you decided you no longer want to buy a house. So very beneficial. The investment return. So it is worth thinking about this as well. There are some issues. There are some benefits that the government gives you in terms of investment returns if you do go through poor periods or not poor periods. But if you go through somebody like ourselves, what you can do is you can opt to have that held outside of super as sort of cash, or you can opt for it to be used as a market return. So the idea is that it's a bit like, how do you want to save this? Do you want to use this? And we do something where we put a target date on it. So let's say you said, yep, I've got a target 3 years. I want to put away $1,000 a month for the next 3 years, and hopefully I'll be close to the 50,000 limit, and I'll be able to then go and buy a house. And you can do that, both partners if you've got two people doing this. But anyway, if that's your target, we'll then put in a 2028 bond for you, which is effectively like a term deposit, and you know what return you're going to get. You're going to get a 4.5% return or a 5% return on all that money, and you know that I've saved 36,000 and add in the interest, and I'm over 40,000 as to what I've got for that period, and that's sort of locked in, and you know what it is. The flip side is you can just let it run with the market, and market goes through a good period, you'll get there faster. Market goes through a bad period, you might get there slower. But that thought around that, it is worth noting that investment return, particularly if you've got sort of particular timeframes and you just don't want to be at that period where markets have a terrible 2 or 3 year run, and you got to it takes you another 6 months or 12 months to get to where you want to. So keeping that in mind. Just going to go to a quick message, and then they've got a whole bunch of questions that I really wanted to run through some of the answers to.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Right, so a couple of questions, and sort of fading into some of my final thoughts as well that I had on this. One is, what's the easiest strategy to start before 30 June? Look, absolutely looking at adding extra money and working out where your contribution caps are. So you can get this from your MyGov site as to what your contribution, how much you can put in. So you want to put in, if you can maximize that $30,000, that's great, because that it's usually typically a big cost saving for you, as long as you're earning over, say, 45,000. There's a big tax saving. You can halve your level of tax within some of these. So that's one thing I'd be certainly looking at. It is worth noting as well about these contribution levels. If you're getting close to your sort of 500,000 limit, then you have this chance to backfill some of your prior years. And so, and you can do that sort of all in one go. Whereas if you just, as soon as you step over that 500,000, so it's an arbitrary number as well, but you're at 499 at the end of 1 year, all of a sudden you can do this big catch up and add, say, $100,000 worth of money and get some huge tax savings on that in terms of what you're getting back from the government. Whereas if you're at 501, all of a sudden you can't do that anymore. So, or you can't get those prior years back. So yeah, so keeping in mind that before 30 June, check what those balances are and whether you've got that capability of putting that money in there and claiming that extra tax back. That was from Ethan Parker. Another one from Scott, retiring soon, got some assets. That's a classic one for having a look at what are your assets, where are they, should they be in super or not within super. And that's based on those levels. If you're sitting below that sort of 1.9 million, $2 million, 1.9 million cap at the moment, 2 million next year, you probably want that in your super and where you can get tax free. If you're sitting close to the thresholds, then you might want to think about it. And then also as well, just thinking about where it sits in terms of tax. So one thing to say, yeah, look, I'm going to, you might have had an investment property for 10, 15 years and say, yeah, great, I'm going to sell that, put that money into superannuation so that I then get it, tax-free in terms of retirement. Sounds great, but if you're about to realize a, $100,000 tax bill from selling that house that you might not have otherwise raised in order to get it into super, in order to save $100,000 over the next 10 years, is like, well, why not just not pay the $100,000 in the first place? So so very much maximizing, trying to make sure that it makes sense in terms of what you're doing within that. It is worth noting as well that for people wanting to put, particularly people looking to put put property into a self-managed super fund, is that a lot of these new rules are going to make things worse for you as property, and particularly the tax on unrealized gains that you might get out of that. So just a word of caution for, I've already cautioned a few times, property within a self-managed super fund just has much higher fees than what you pay outside. So the idea is if I wanted to buy a house, for example, as an investment property, and I had the choice between doing it in my own name or doing it within super, if I do it within super, I'm probably talking about $2,000 to $5,000 of extra costs every year, plus a whole bunch of all these other things that's going to fade in, plus a whole bunch of extra setup costs and stuff like that. It's a high cost strategy. For some people, it's just like, well, otherwise I'd never be able to do it anyway, and so I'm just going to do it. But it is worth noting that often the tax benefits of and just cost benefits of doing property in particular inside your own name is much better. And then we've got this thing about the level of assets within these. So what you can find is, if your whole goal was to get property into your self-managed super fund, and they're starting to put these caps on, you might suddenly find in 10 years' time that you're being taxed on unrealized gains in your property, and you may not have the cash to do that within that. So if you put all your money into buying a property, and that's pretty much your own asset sitting in self-managed super fund, and then all of a sudden the government starts turning around and saying, we're going to tax you on the unrealized gains of that, which is the way it looks like it's headed at the moment. That's going to create cash flow issues, and in the worst case, you've got to sell the property just to pay the tax bills on things like that. So where are we? Recontribution strategy worth it for somebody in their 50s? Look, the recontribution strategy is really about minimizing the any inheritance tax. If you are concerned about dying early, then you want to be thinking about that. If you're, and you can't do it. You're unlikely to be in your pension phase anyway in your 50s. You need to be in pension phase to actually run a recontribution strategy. But mostly that's for people who have large balances in super and aren't worried about that money running out, so to speak. It's like, yes, I don't, if I've got, our rough estimate is if you've got 2 to 2.5 million in super, in investments, 2 to 2.5 million in super and investments, then you can very comfortably live off the dividends from that, grow the balances, and you probably, the balance is going to go up over time, not down, unless you've got, much very high living costs, I suppose, relative to the ordinary person. So so the idea there is that recontribution is about trying to get that balance down, because you're expecting to still have something left. If you've only got a few $100,000 and you're expecting that to run down over time and then move on to the pension and things like that, there's no sense in trying to worry about recontribution strategies, particularly if you're expecting or hoping to live to a long age. Now, concessional, non-concessional, I will talk about this just quickly, just in a broad sense. I spoke about the big picture. I tried not to use these words because that's where it all gets confusing. But I spoke first about one strategy is reducing your income tax at the moment. They tend to be concessional things that you're going to do. So when someone talks about concessional contributions, usually what they're talking about is getting your income tax level down. When people talk about non-concessional, it's about trying to shove more money into your super so that you can take advantage of these tax-free retirement income streams. So that's your sort of big picture when you hear concessional, non-concessional. But then each sort of different strategy has got its own sort of rules and reasons why. And then should you change your superannuation strategy? Based on upcoming financial year and traps, common mistakes to avoid with end-of-year contributions. Yeah, absolutely. When you're close to the limits, if you tip over that limit, it can be expensive. The one thing, there's this division, I've forgotten the name of it, division 493, maybe. 293, the division anyway, that if you pay too much, if you pay above that 30,000 cap limit, you get these division 293 statements back from the government, back from the tax office saying, here's your extra tax, you got to pay it. Now it sounds bad and it hurts. It always hurts. Like when people have these, let's say you've put $10,000 too much you've blown your limit, you put $10,000 too much. Is they're going to come back to you and say, right, you now owe us $1,500 worth of extra tax. Now that sounds bad. And people hate paying that extra money, $1,500, back to the government. Typically, though, whenever you look at these, that $10,000, if you had received that in your own name and you're on the top, $4,700 worth of tax, and even if you're on sort of an average tax rate, you're gonna have to pay $3,200. So getting away with only having to pay $1,500 extra is not that bad. And you can, in most cases, pay that out of your super. So, your super's got the benefit, it's got that extra money. You can just say, oh, let my super fund pay that extra amount. So they sound bad. They always hurt whenever you have to pay more tax versus it just having taken out and you don't even notice it. But keep in mind that, if you do get one of those, and particularly if you're on a higher income tax level, you're probably better off, even though you're paying it and it hurts, you're probably better off than you would have been if you had a different strategy. And I think that's the main thing I sort of leave people with is your other danger with a lot of these that most people think about is, look, if I pour this extra money into super, what happens if they change the rules and then start taking more and more of my super? And I'm going to end up paying more tax. Now, not saying that can't happen. It might, but my view is that's highly unlikely. Even the changes we've seen now where we're adding these extra tax levels at 3 million or 2 million or wherever it's going to be, you're still better off having your money inside super rather than outside of super in almost all cases. It's very rare circumstances where you'd say that that's the case. And, for all the, the teeth gnashing and the complaining you hear from people about, they're changing the rules and whatever it is, whatever this new tax rule is, it's making things worse for me. If you gave that person the option, well, okay, would you like to take your money outside of super and have it in your own name instead? In almost all cases, they're going to say, no way would they want their money in their own name, because they're going to have to pay far greater levels of tax sitting in their own name than what they're going to have in super. And I expect that to be the case going forward. So, yeah. Anyway, that was all I really had today. We will have a calculator out soon on our site, which will sort of add a checklist for Nucleus Wealth customers and non-customers to check. So that'll sort of come up in the next week or so. We'll put some links to that for you and post out a little bit more on this. But I think the big message is lots of tax savings you can make within superannuation. Some of these is about having a longer term strategy, particularly about that idea about getting more money into super over time. And I've done some other posts you might want to reference in the past is about saying, if you've got spare money, should you pay down your mortgage or put it into your super? And there's a whole bunch of different calculations and stuff like that you can do around that. But the short answer is on a high tax bracket, it might be worth it, but on lower tax brackets, it's almost always worth paying down that mortgage first before even though you do get that sort of big kicker for when you add up the savings over the longer term, you often do end up better off with the mortgage, except at higher income levels. Yeah. Anyway, with no further ado, I just want to highlight. You can grab our stuff on a whole bunch of different places in terms of Spotify and Apple Podcasts, and we're on YouTube live every week at 12:30 on a Thursday. Thanks for listening. Hit the like and subscribe button. If you've got any comments, sort of pop them in, or questions or things you'd like to see covered in future podcasts, and also Nucleus Wealth /content. You can register for our newsletter and get all this sent to you each week, plus any other thoughts and we have going on. Thanks for your questions and comments, and we'll speak to everyone next week.